Dear friends, in the previous session we discussed about the factors influencing dividend policy. Having studied the factors influencing dividend policy, now in this session we will briefly understand various theories of dividend policy. I think a fundamental understanding about various theories of dividend policy is essential for you to understand the importance of dividend policy. So, that is why we will briefly touch upon the concept of the various in a brief about various theories of dividend policy we will discuss. In fact, there are several theories that attempts to explain how dividend decisions affect firm value and shareholders' wealth. So, when it comes to the theories of dividend policy, this theories mainly discusses about some theories says that dividend needs to be paid, but some other theories says that payment of dividend is not significant. So, two important aspects here in dividend decisions. One is it affects the firm value and it affects the shareholders' wealth. But some theories says that the payment of dividend is not significant at all. So, what is the justification for various theories also we will discuss. First of all, the theory given by Modigliani and Miller. Modigliani-Miller's theory of dividend is called as the irrelevance theory. Irrelevance theory, as the name itself suggests, that in a perfect market condition with no taxes or transaction cost, the dividend policy does not affect the value of the firm. So, Modigliani-Miller's theory, irrelevance theory, is based on certain conditions, and condition is this: in a perfect market condition with no taxes or no transaction cost, dividend policy is not relevant or payment of dividend is not required. That is not going to affect the value of the firm. So, according to this view, investors are indifferent between receiving dividends or capital gains, because they can create their own dividends by selling the shares. That is what irrelevance theory says, because if dividend is not received also, they can create their own dividend by selling the shares at a premium rate. And for that, for both the cases, selling of shares at a premium or receipt of dividend, in both the cases it is assumed that there is no tax. But in reality that is not the case, because in both the cases payment of receiving a dividend as well as capital appreciation, dividend is there, and also a perfect market condition it is difficult to find in the modern markets. So, irrelevance theory has its own limitations. So, in a nutshell, you need to understand Modigliani-Miller's theory says that payment of dividend is not compulsory, it is not mandatory, and it is not going to make any changes in the value of the firm. Then another theory is a bird in the hand theory. Bird in hand theory, Myron Gordon and John Lindner introduced this theory, bird in hand argument. According to this theory, the dividend policy does affect the stock price, and a high dividend payout can lower the cost of equity capital and increase the firm value. So, bird in hand theory says about or talks about relevance of payment of dividend. It is important that the company should pay dividend, and the name itself says bird in hand. That means, suppose in your hand one bird is there, you catched one bird. If somebody says that if you release this bird which is there in your hand, that bird will attract a group of herd of birds, and you will be able to catch all that birds, a herd of birds you can catch. If somebody says that, will you release the one which is in your hand? That is the question. The problem here is, if you release the one which is there in your hand, there is no guarantee that you will be able to catch more birds in the future or after releasing that. There is no guarantee. Same is the case with the payment of dividend. In previous sessions we discussed, when we discussed about dividend policies, major portion of the profit will be retained in the business for reinvestment, and a small amount will be distributed in the form of dividend, and equity shareholders will agree for that. Even if dividend is not paid also, equity shareholders sometimes will agree with the expectation of getting more return in the future. Why? Because major portion of the profit which are supposed to be given to the shareholders are reinvested in the business. So, from that reinvestment in the future they can expect more profit or more return. But bird in hand argument says that in any year, if a company says that this year no dividend, that amount also we will reinvest, and from that investment you could make more profit in the future. This bird in hand theory says that shareholders won't agree for that. Why? Because now what is available for dividend, they expect that now, and if the company says that in the future you will get more dividend if we forego the dividend for this current year, means usually the shareholders will not agree for it. Why? Because 1 rupee today is better than the 10 rupees which may or may not come in the future. So, that is what a bird in hand argument says. It says that it is important that the company pay dividend, otherwise it will have an impact on the stock price, and high dividend payout ratio can lower the cost of equity capital and increase the value of the firm. So, if higher dividend is paid, then the market value of the market value of the shares of the company tends to increase. That is what bird in the hand theory says. Next is tax preference theory. Tax preference theory. This theory suggests that investors prefer capital gains over dividends because capital gains are often taxed at a lower rate than that tax on dividend. So, on the consideration of tax, shareholders prefer capital gain than getting dividend. Reason is, tax on dividend usually is higher than tax on capital gain. So, investors prefer capital gain instead of dividend. So, as a result, companies that reinvest earnings or buy back shares may be more attractive to investors, leading to a preference for low or no dividends. So, that is what tax preference theory says. So, people give preference to tax rate, so tax burden. So, as per this theory, since tax on dividend is more than tax on capital gain, people prefer for capital gain than dividend. That is what tax preference theory says. Another theory, signaling theory. So, what this signaling theory says is, in any year, if a company fails to pay dividend, or if a company pay dividend lesser than paid in the previous years, then it shows a signal among the public that the company is not performing well. That is the meaning. But if there is an increase in payment of dividend, year by year there is increase in payment of dividend, it shows a signal that the company is confident, the company is profitable, company is financially healthy, and also the company is expecting future good returns in the future. So, while a dividend cut, a dividend is not paid or paid less, means it shows a signal of financial distress of the company. So, that is what signaling theory, as the name suggests, signaling theory. Payment of dividend or not payment of dividend shows a signal. Payment of dividend, regular dividend, or paid more than what is paid in the last year, then it shows a positive signal, the company is healthy. Dividend is not paid or paid lesser than the previous year, it shows a signal that the company is not healthy. That is what signaling theory says. So, as per this theory, it is better for the company to pay dividend to show that the company is healthy. Agency theory. Agency theory. According to agency theory, paying dividends helps mitigate agency cost by reducing the free cash flow available to managers. That means, by distributing excess cash, the company limits the funds available for managers to invest in potentially unprofitable or wasteful projects, thus aligning managerial interests with the shareholders' interest. Agency cost means the managers of the company, the directors of the company, the management of the company are considered as the, they are the agents, they work for the benefit of the owners of the company. Here agency theory says that if more money is retained in the business, the management is duty bound to invest that money. So, they are duty bound, they are forced to invest that money which is retained. Otherwise, simply keeping money in the business is dead money, it will not generate any income. So, if instead of paying dividend, if major portion of the profit is retained in the business, then the management will be forced to invest that money. Often that end up in investing potentially unprofitable investment opportunities. So, this theory says that unnecessarily it creates agency cost. If there is a profitable investment opportunity, it is better to retain. Otherwise, instead of retaining, dividend has to be paid. That is what agency theory says. I hope it is clear to you. Agency theory says that if money is retained in the business, then management will be forced to reinvest that money. Even they need to find out the investment opportunities, and often they may end up in investing unprofitable or wasteful projects which won't generate any positive returns. So, that is another theory, another dividend theory. So, now we have discussed about various theories of dividend. Irrelevance theory proposed by Modigliani Miller, then it says that payment of dividend does not influence the or does not affect the value of the firm. A bird in hand argument, that means minimum dividend has to be paid. People won't wait with the expectation of future returns. Then tax preference theory, dividend tax on dividend is usually greater than capital gain tax. So, they investors, shareholders won't prefer dividend, instead they prefer capital gain. Signaling theory, if dividend is not paid or paid lesser than what previous year paid, it shows a signal that the company is not performing well. Then agency theory, if more money is retained than payment of dividend, in such cases management will be forced to invest that, to find out some investment opportunities. They may end up with investing in unprofitable projects. So, having understood the theories of dividend, now let us understand the advantages and disadvantages of paying dividend. So, advantages and disadvantages of paying dividend, that we will discuss in the next session. Thank you so much.